Chapter 10, Fundamentals of Cost Management. In this chapter, we're going to dive deeper into activity-based costing, ABC, and we're going to see how we can use that to refine some of our data and perhaps make more accurate decisions in cost management. In ABC, we're going to assign costs based on activities instead of assigning costs based on one overhead calculation, one allocation base. We try to break down costs into subcategories to help pinpoint and assign costs more accurately. Companies that use activity-based management, they can focus on managing those activities to reduce costs. When overhead is just one single rate, it can be hard to narrow down certain areas that we can cut costs in, but when we refine those costs into smaller cost drivers and smaller sub-allocations, then we can possibly refine our cost information and cut costs accordingly wherever reasonable. Here are some examples of costs and also cost drivers. Some of the costs can be fairly specific, like under volume related, you have lubricating oil and machine repair. Those are pretty specific types of costs, and those tie into, in this example, machine hours and number of units. The costs can also be more general. So under facility related, you have general plant costs and plant administration costs. And so sometimes the costs and the cost drivers can be very accurate. Sometimes they can still be fairly high level and broad. But the point is that if we can narrow down our focus so that we can track costs more accurately, then we can make better decisions in where we can cut costs. This information can be essential to determine whether or not certain customers are profitable. When we use just one allocation rate for overhead, often two different customers might seem like they are both equally profitable to the company, but when you dive deeper, one customer might actually be costing the company a lot of money, and the other customer might be even more profitable to the company than originally thought. So, of course, the number one reason for the existence of any company for profitability. And so this information can be essential so that we can improve firm performance and maximize profitability. Common sense tells us that customers use some of the company's resources. Examples that this slide gives are when a customer has to purchase a ticket. You're going to have a ticket seller or some sort of clerk to record the transaction. When you check in for a flight, you're going to have the people at the ticket counter or the baggage counter helping you check in. Or when you make a transaction in the bank, you're going to have a teller at the bank that'll facilitate that transaction. And so some customers that go to the bank more often than others are going to consume more of that bank's resources. Or someone who stands in line to purchase a ticket is going to consume more resources than someone that just buys those tickets online. So different customers are going to have different costs and are going to use more or less resources of the company. So the company is going to want to identify activities that consume resources, identify the cost drivers associated with each activity, compute a cost rate, and then assign costs to customers based on that cost driver rate. This slide gives the example of two customers, Mario's and Claire's, and they are customers of Lygon Food Distributors. Both of these customers buy $50,000 of goods from Lygon, and the cost of goods sold, the profit margin is going to be the same for both. So both customers give the company a gross margin of $20,000. So from a brief overview, it looks like Mario's and Claire's are about the same type of customer profitability towards the company, but we're going to dive into the numbers a little bit deeper. Now, Lygon deliveries, and Lygon is charging each customer a 16% delivery charge. It appears that Mario is happy with this charge, but Claire's is not. So we're going to have to look at the numbers and figure out why. Why is Claire's trying to change distributors while Mario is happy? And so we're going to break down these deliveries into 3 different activities: entering the order, picking the order, and delivering the order. We've determined that for entering the order, the number of orders entered is a good way to track that cost. For picking the order, it's the number of items picked. And for delivering the order, it's the number of deliveries made. And then there's a 4th cost driver, general delivery administration, and that's going to be based on the value of the order. Breaking down these costs, it tells us that entering the order in cost us $100,000. That's probably going to be mostly labor. There are employees that have to enter in the orders. There were 10,000 orders, so 100,000 divided by 10,000 is $10 per order. Then you have costs for picking the order and delivering the order. And then you have the delivery administration costs of $250,000. We take these 4 costs and we break them down into a cost rate, an allocation rate. And so instead of taking the delivery costs and just charging the whole thing based on one overhead rate, we're going to break down those costs into the 4 different sub costs and then charge them based on 4 different allocation rates. And so we look at Mario's and Claire's. Remember that Mario's and Claire's both purchased the same dollar amount of items, but it shows here that Mario's has 150 orders, but Claire's only has 50. So that means that Mario's is making 3 times as many orders, and so these orders are going to be a lot smaller compared to Claire's, who is making just a few orders, but those orders are going to be bigger. They both order the same number of items, 750, so that means, again, that Claire's is making big orders with a lot of items in each order, whereas Mario is making smaller orders. And that's also evident in the number of deliveries. Claire's only needs 50 deliveries, whereas Mario's needs 200 deliveries. So it's quite a different picture when you look at the numbers in depth rather than just looking at the order value of $50,000. It tells quite a different story. So because Mario's makes way more orders and has way more deliveries, their activity cost is way higher. So for entering the order, the cost for that is $1,500 compared to Claire's is only $500. And then for delivering the order, Mario's deliveries is costing the company $4,800, whereas Claire's deliveries are only costing $1,200. So remember that $8,000 in delivery charge that both companies have to pay. Well, for Mario, he's getting a good deal because his total delivery cost is $10,300. So for him having to pay only $8,000, he's getting a pretty good deal. Whereas Claire's, she feels like she's getting ripped off a little bit because she doesn't use the delivery service as much. So she's not costing the company that much money. So she, in turn, feels she's not getting her money's worth by paying $8,000. A similar type of analysis can be done on the other side. It can be done with your vendors or your suppliers. In this situation, Lygon is using Pacific Foods and Coastal Supply as their vendors. Looks like the company buys more product from Pacific Foods. They buy 600,000 pounds of food compared to the 400,000 purchased from Coastal Supply. The price is about the same. Pacific Foods is slightly cheaper at $2.01 versus $2.02. So maybe that's why the company buys from Pacific Foods a little bit more often. And so it stands to reason that the total value of the product purchased from Pacific is higher than Coastal Supply, and the number of deliveries is also higher than the number from Coastal Supply. Now, one big thing to note is that Pacific Foods is late 50% of the time, whereas Coastal Supply is on time 90% of the time, so they're only late 10% of the time. So being late can be a big issue. If deliveries run late, then you might have to ask your warehouse workers to stay later. You're going to have to pay them overtime. Or if deliveries arrive late, then maybe you don't have enough supply to give to your customers, and your customers will in turn not be happy. Also, it makes managing inventory more difficult when deliveries are late. A lot of companies nowadays are using just-in-time inventory where they buy just enough supply to last them through a certain number of days or weeks, and they calculate right when they're going to run out of supplies. That's when the next shipment comes in, with a little bit of a cushion, of course. But a lot of times companies cut it pretty close so that they don't have a lot of excess supply sitting on their shelves. But if you're going to have a supplier that is constantly late, then you're not going to be able to use just-in-time inventory practices as diligently as you might like. So that's another consideration whenever you're using a vendor that's consistently late. This slide demonstrates that late delivery can cost the company some money. So again, Pacific Foods is a little bit cheaper than Coastal Supply, but Pacific Foods is consistently late. They're late 50% of the time. If the additional cost of late delivery is 10 cents per pound, and if Pacific Foods is 50% late, then that means that the price of the product is not $2.04, it's $2.04 plus 5 cents. So the effective cost is actually $2.09. You compare that to Coastal Supply, their price is $2.07, but they're only late 10% of the time. So that would be 10 cents times 10%, which is 1 cent. So 207 plus 1 cent gives you 208 as the effective cost per pound. So when you take into consideration the late deliveries, Coastal Supply ends up being a little bit cheaper than Pacific Foods. Another concept that we're going to cover in this chapter is resources. We're going to calculate resources used versus resources supplied. So resources supplied is the amount of resources available. Resources used is what you actually used. And the difference is going to be unused resource capacity. And so in this chapter, we're going to see how to apply the costs for the unused resource capacity. Do we apply it to the items that we actually created, or does it become a period cost? It's going to depend on the reason for the unused resource capacity. We're also going to work with different levels of activity. Actual activity, which is the number of items that we actually believe we're going to create in the period. Theoretical capacity is the best case scenario where we don't have any machine breakdowns, we don't stop for maintenance or for employee issues. What is the absolute maximum number of items we can create theoretically if everything worked perfectly? So theoretical capacity is the best case scenario, but it actually never happens in real life. You have practical capacity, which does account for breakdowns and maintenance and employee issues. And then you have normal activity, which is the long run expected volume of production. So when we're using normal activity, the cost of used capacity is charged to the product, and the cost of the unused capacity, which we mentioned, is charged as a period expense. Now, depending on which capacity we use to allocate costs, the operating cost rate can be very different. If we're basing our number on theoretical capacity, then in this situation, the fixed operating cost rate per passenger is $100 per passenger. Now we know that this is not going to be an accurate number, because for theoretical capacity, that's almost impossible to hit in real life. If you use practical capacity, the number is 125 per passenger. If we're using normal activity or actual capacity, if we're using normal activity or actual activity, the number also changes. So it's very important to read the question and determine which capacity, which level of activity they want you to use to calculate the operating cost. The example used in the book is an airline. Airlines are going to have additional airplanes that they're not using whenever it's not busy season. They have enough airplanes to fly during the busy season to try to meet demand, but those airplanes are still going to be with them when they're not in busy season, when they're in off-peak season. So during that time, some of their planes might be sitting idle. So the company has to decide how to allocate those costs for the idle airplanes. In the graph shown, in the winter, there's only 800 passengers that they fly around compared to 1,600 passengers in the summer. And so they have this cost, which is represented by box A. They don't know where to allocate those costs to. They can allocate them perhaps towards the other winter passengers, or maybe they're going to allocate it to summer, or maybe they'll just do both. So depending on how they choose to allocate, the numbers are going to change accordingly. This chart shows different scenarios with the company allocating costs in different ways. So if those extra costs are classified as a period cost, then it shows that the overall reported cost per passenger is only $125. Now, what if they allocate those costs to the other winter passengers? Then that cost adds to the winter passenger cost, and it shows that winter passengers cost $250 per passenger. Or if they split up that unused capacity cost among all their passengers, then it raises their reported cost per passenger. So again, there's no perfect right way or wrong way to do this, but we always have to look at the data and apply our actual knowledge to it rather than just looking at the raw number. Let's say that we decided to allocate the cost to the winter passengers. Well, if you look at the winter passengers and you see that their cost is $250 per passenger, you might think, oh, well, we should raise the ticket price for winter passengers. But really, that's the wrong thing to do, because in the wintertime, that's not peak season. So people don't necessarily want to travel as much. And so what happens when there's lower demand? Then you're going to have to lower your prices to try to get that demand back up to where it needs to be. If you raise prices during a time when people aren't really interested in flying anyway, then that's going to just end up hurting the company even more. So again, we don't want to just look at this reported cost per passenger and decide that we're going to raise prices just because cost is high. We want to take this data and apply our knowledge to it and make logical decisions. Another concept in this chapter is conformance costs. We're going to have conformance versus non-conformance costs. Basically, the idea is you're going to have costs for quality. Either you're going to have costs for reviewing your processes, reviewing your items, inspecting your items, making sure that they're good quality. You're going to train your employees well. You're going to inspect your machines. You're going to make sure that your products are designed properly. All of these have costs. So some companies might want to cut costs by not performing these tasks. Well, on the flip side, you have non-conformance costs. This is costs when the products fail. And when the products fail, if they fail while they're still at the company, You might have to scrap the items, you might have to rework them, or you might have reinspection and retesting costs. Or if they fail after the customers get a hold of the items, then you're going to have warranty costs, you can have liability costs, marketing costs, and you're also going to have lost sales. So you're going to have costs one way or the other. You're going to have costs either through quality checks in the beginning, or you're going to have costs from warranty repairs and product liability issues afterwards. So there's no escaping the cost, really. What you want to do is find a good balance between the two. So this chart shows that total cost of quality will go down to a certain point and then it'll start increasing again. So the way this chart reads is if you don't have any conformance costs, so you're not doing any real testing and you're not focusing on product design, then you're going to save money on conformance costs, but you're going to have high non-conformance costs. You're going to have high warranty costs. Now, if you increase your conformance costs, so you're increasing your testing, your non-conformance costs, like your warranty, is going to fall. And at some point, you're going to keep increasing your conformance cost, and your non-conformance will continue to drop, but it'll start leveling off at a certain point. So this chart tells us that our lowest total cost of quality is at this point. So we've done a certain amount of conformance cost, and our non-conformance cost has fallen. And so a company has to decide how much to spend on conformance and non-conformance costs. If a company really wants to distinguish itself as a high-quality type of company with high-quality products, they're probably going to want to increase conformance costs, and that way their non-conformance cost decreases. Now, at some point, as we mentioned, the increased conformance cost is not going to pay off in terms of overall quality cost, but it will pay off with their reputation. Now, what if you have another company that they're not trying to position themselves as making premier products? Well, that company is probably going to want to aim for conformance costs at this point, where they do just enough conformance cost to bring their total cost of quality to the lowest point. And then they also understand that they're going to still have some non-conformance costs in terms of warranty repairs and returns, but they're willing to accept that hit on their reputation in order to maintain low total cost of quality. So it really depends on what type of company and what reputation that company is shooting for. And that's the end of chapter 10.